You are under no obligation to pay more tax than you're legally required to. These loopholes are available to everyone. You just never bothered to learn about them. That's an expensive tax to pay for being lazy. Number 1 on this list is the only strategy that lets you cash out a $10 million asset, get paid for the rest of your life, and leave your kids the full amount, all without the IRS seeing a single dollar. Here are 15 tax loopholes rich people use that you've never heard about. Welcome to A-Lux, the place where future billionaires come to get inspired. Number 15. Upgrade your home 4 times in a decade, tax-free. Also called the 121 exclusion, plus live in your flips. There is something called the Section 121 of the Internal Revenue Code, and it's one of the most generous gifts the IRS has ever handed the average American. Almost nobody outside the real estate world uses it strategically. But here's the deal. When you sell your primary residence, you can exclude up to $250,000 of capital gain from federal taxes, $500,000 if you're married, as long as you lived in the home for at least 2 out of the last 5 years. In real estate, we call it living in your flips, or tax-free home upgrade. Here's how it works. You buy a fixer-upper, you move in, you renovate while you live there. After 2 to 5 years, you sell. You pocket up to $500,000 in tax-free gain. Then you do it again. Do this 4 times across 10 years, and you've created $2 million in tax-free wealth without paying a dollar of capital gains tax. Not to mention, you've upgraded your home 4 times and now have real wealth. And here's a real-world example, okay? A married couple in Austin, Texas, bought a 1970s ranch home in 2018 for $400,000, renovated it over 24 months while living in it, sold it in 2020 for $850,000. Tax-free gain, $450,000. They rolled the money into their next fixer-upper. By 2026, they've done this 4 times. Their net worth from this strategy alone is over $2 million. They've combined a W-2 income of $180,000. The IRS has touched none of it. Many young people complain about not being able to afford a home because they think of their forever home, the one they're going to grow old in, when in reality, this path right here allows you to build your net worth toward that forever home in a way where you use the tax system for your benefit, because it was designed to help you. This is the single most accessible loophole on the list. You need enough capital for a down payment, the patience to renovate while living in the home, and the discipline to upgrade your life every time you buy a new iPhone, which is roughly every 2 years or so. Number 14, make your kids millionaires by minimizing your taxes, known as hire your kids. Section 162. You can hire your own kids and pay them a real salary through your business. As long as the work is real and the wage is reasonable, the IRS allows you to deduct the wage as a business expense. Your kid then earns up to $14,600 a year and pays 0 in federal income tax. That's the standard deduction for a single filer in 2026. Then it gets better. You take their earned income and put it into a custodial Roth IRA in their name. The Roth grows tax-free for the next 50+ years. Let's run the math on this because you're not going to believe it. Okay, if you fund $7,000 a year into your kid's Roth from age 7 to 18, then they never add another dollar after that. By the time they retire, that account is worth approximately $2.3 million, all tax-free. The Trumps did this. The Romneys did it. Most wealthy families with private businesses do this from the day the kid can hold a camera or carry a clipboard. You hire your 9-year-old as a social media model for your company's marketing photos. You hire your 12-year-old to file paperwork twice a week. You hire your 16-year-old to manage your business's TikTok account. The work has to be real. The wage has to match the market. The IRS allows it. Meanwhile, in the rest of the world, we had to help around the family business all day, every day, with no pay. Number 13, rent your house to your business tax-free. The Augusta Rule, Section 280A. Now, this rule only exists because of golf. Every April, the Masters tournament rolls into Augusta, Georgia, and rich people from around the world fly in for the week. The local homeowners realized they could rent their houses to corporations attending the tournament for 5-figure weekly rates. Lobbyists got the IRS to write a rule for them. Section 28AG, known as the Augusta Rule. You can rent your personal home for up to 14 days a year, and the rental income is completely tax-free. Doesn't matter how much you charge. Doesn't matter who you rent it to, including yourself. Wealthy business owners realize they could rent their own home to their own business. So here's how it runs. You own an E-Score or an LLC. You hold a real board meeting at your home. Real agenda, real decisions, real documentation. You charge your business a fair market daily rate, usually $1,500 to $5,000, depending on your area. The business deducts the rent as a business expense. You receive the money personally and pay zero income tax on it. That's another 40 to 50 grand you can take out of the business just for checking a box. Talk to your CPA to get clean documentation for this. Run 14 brainstorming training meetings out of your house per year and get the equivalent of what the Airbnbs rent out in your area is tax-free. As this video goes on, the strategies get more practical. Number 12, 20% off your taxes on behalf of your government. The 199A pass-through deduction. So, if you own an LLC, an S-Corp, a partnership, or you're a sole proprietor doing under $500,000 a year in profit, Section 199A of the tax code lets you take 20% off the top before you owe $1 in taxes. Make $300,000 in profit. The IRS lets you ignore $60,000 of it. You save roughly $22,000 in federal taxes. Yep, just like that. Why does the government do this? Well, because in 2017, Congress cut the corporate tax rate from 35% down to 21% for big corporations. Small business owners pointed out that they were now paying a higher tax rate than Amazon and Apple. So Congress threw them a bone. The 20% deduction was the bone. It's a permanent gift to anyone who owns their business in America. Half of small business owners either don't know it exists or they claim it wrong. But there is a catch. Above $241,000 single or $484,000 married, the rules tighten and certain professions like doctors, lawyers, accountants get phased out completely. That's why your dentist owns 4 different businesses. One company is the dental practice itself. Above the income limit, the practice doesn't qualify. A second company owns all of the equipment, the chairs, the imaging machines, the lasers. The practice leases the equipment. A third company owns the building the practice operates within. The practice pays the rent. The real estate company qualifies. A fourth company handles the management, the billing, the IT, the front desk staffing. The practice pays the management fees. Same dentist, same patients, same revenue. Just sliced into 4 entities, so each piece can claim its own 20% deduction. So ask your accountant, am I claiming the full Section 199A deduction? If they look confused, you need a better accountant. Number 11, erase your salary tax with oil money. Oil and gas intangible drilling costs, Section 263C. If you put money into an oil and gas drilling project, the IRS lets you deduct 60 to 80% of your investment in the same year you write the check. Put $100,000 into a drilling partnership in December. Deduct $70,000 on your tax return in April. If you're in the top tax bracket, that's roughly $26,000 in federal taxes you don't owe. Drilling for oil is expensive and risky, and the United States wants companies to keep doing it instead of relying on imports from countries we don't trust. Actually, it's a loophole disguised as energy policy. So here's how the rich use it. A tech executive cashes out $4 million in stock options. They're facing a $1.5 million federal tax bill. So in December, they write a $500,000 check to an oil drilling partnership. Their tax bill drops by roughly $130,000. Hedge fund managers, tech executives, doctors selling their practices use it as one of the only legal ways to wipe out a huge salary or stock comp year. Oil and gas partnerships are available to accredited investors only, which means you need $1 million in net worth, excluding your primary residence. And if you're not an accredited investor, there's still hope. Section 179 lets you deduct up to $1.16 million in business equipment. Buy the equipment in December, take the deduction in April. Number 10. Use a vacation rental to cancel out your day job taxes. Cost segregation plus the short-term rental loophole. You buy a $900,000 property and run it as a short-term rental on Airbnb or Vrbo. You hire someone called a cost segregation specialist for around $5,000. They walk through the property and put every component on a faster depreciation schedule. The carpets, the appliances, the lighting, the parking lot, the landscaping. Each one gets written off faster than the building itself. The result? Instead of slowly depreciating the property over 27.5 years like a normal landlord, you write off 20 to 30% in year one. That's $240,000 in paper losses on your first tax return. So here's where the loophole lives. If you're the property manager, those paper losses don't just cancel out rental income, they cancel out your day job income too. A software engineer in San Diego making $450,000 a year buys a $900,000 Airbnb in Joshua Tree. After the cost seg, their taxable income drops to $210,000. The best part is that you now have a holiday home that earns you cash flow, deducts your taxes on your main income, and you can use it whenever you want to escape. The only downside is you need to spend a minimum of 100 hours per year managing it. Now, everything in this video is insider knowledge that would cost you tens of thousands of dollars in just consulting fees alone. The real estate CPA who structures your STR loophole charges $5,000 a year. Segregation specialist charges $10,000 per study. The ALUX app costs $1.99 per year. Same playbooks, same frameworks, access to a private community of people climbing the same wealth ladder. So download it at alux.com/app. And since we're in a savings mood today, if you scan the QR code on screen, you get 25% off. Number 9, donate stock, never pay capital gains. Look generous for 30 years. Donor-advised funds, or DAFs, Bezos, Zuck, Gates, they all use this one because it's the biggest charitable tax move in America. Let's say you bought $50,000 worth of NVIDIA stock. It's now worth $1 million. If you sold it, the IRS would take $190,000 in capital gains tax. You'd be left with $810,000. Instead, you donate the stock to a donor-advised fund. Not the cash, the actual shares. 3 things happen at the same time. 1, you get a $1 million tax deduction this year. That's a $1 million tax deduction on any income worth roughly $370,000 in federal taxes saved. 2, you never pay the $190,000 in capital gains because you never sold. And 3, the full $1 million now sits in a charitable account. Then you give the money to charities at your own pace over 1 year, 10 years, 30 years. You direct where it goes. The investment grows tax-free in the meantime. Some might hire themselves or a close family member to run the foundation and earn a salary. Fidelity Charitable, Schwab Charitable, and Vanguard Charitable all opened DAFs with 0 minimum balances. It takes 15 minutes to set it up online. Number 8, defer your tax bill into property and never pay it again. Opportunity zones. In 2017, Congress drew a map of economically distressed areas and said, anyone who invests in these zones gets a giant tax break. Long Island City, parts of downtown Manhattan, the area surrounding Trump Tower. Some say that wealthy neighborhoods that absolutely did not need help got designated as opportunity zones because it benefits the rich. Normally, you would owe tax on the gain the year you sold. With opportunity zones, you've got 180 days to roll that gain into an opportunity fund. The moment you roll the money in, your digital tax bill gets deferred. If you hold the new investment for 10 years, you pay 0 federal tax. The trick the wealthy figured out is that you can be the fund. You can start your own qualified opportunity fund with a single property purchase. Number 7. Skip $10 million in capital tax on startup stock. Qualified Small Business Stock, Section 1202. If you hold qualifying startup stock for at least 5 years, the IRS lets you exclude up to $10 million of gains from federal taxes. Imagine being employee number 30 at a Series A startup. You hold the shares for 5 years. The company IPOs and your stake is worth $10 million. Without Section 1202, you owe roughly $2.3 million in federal capital gains tax. With Section 1202, you owe 0, not less, 0. But it doesn't end there. There's a technique called stacking. You can split your stock into multiple trusts, each qualifying for $10 million each. A founder exiting a $100 million company can split the stock across 5 separate trusts and exclude $50 million federally tax-free. Number 6. Trade real estate your whole life. Die, pass it on to your kids, tax-free. The 1031 Real Estate Exchange Plus Swap till you drop. Section 1031 of the tax code lets you sell an investment property and roll the money into a new investment property without paying capital gains tax. Buy a duplex in your 30s for $500,000. Sell it 10 years later for $1.5 million. Instead of paying taxes, use the money to buy an apartment building. Sell that 10 years later for $5 million. Skip paying capital gains again by investing it all into a strip mall or a commercial building. Let's say you own $20 million worth of real estate when you die. Your kids inherit all of it at what's called stepped-up basis. If the kids want to sell it right then, they pay no tax on the $20 million. The IRS resets the value of the property to whatever it's worth on the day you died. All the capital gains you accumulated over 40 to 50 years of trading up, erased, gone. They never existed for tax purposes. Number 5, buy land, promise not to develop it, and deduct millions. Conservation easements. You buy a piece of land with development potential. You then sign a legal agreement with a land trust, agreeing to never develop that land, and you preserve it forever. The IRS treats the difference between the developed value and the preserved value as a charitable donation, so you get a tax deduction equal to the loss in development potential. Donald Trump used a conservation easement on his Mar-a-Lago estate, and he did it again for his Bedminster golf course in New Jersey. The Bass family of Texas, one of the wealthiest old oil families in America, claimed over $1 billion in conservation easement deductions. Number 4, turn a $1,700 retirement account into a $5 billion tax-free fortune. The Peter Thiel Roth IRA. In 1999, Peter Thiel co-founded a tiny startup called PayPal. Thiel opened a Roth IRA, the kind of retirement account a middle school teacher uses. He used $1,700 of it to buy 1.7 million PayPal shares at fractions of a penny each. In 2002, eBay bought PayPal for $1.5 billion. Thiel's $1,700 stake was suddenly worth $55 million sitting inside his Roth. But he kept going. He used Roth money to invest into Facebook. By 2019, according to ProPublica's leak of IRS data, Peter Thiel's Roth IRA was worth over $5 billion. All of it, tax-free, forever. You can still open up something called a self-directed Roth IRA. The move right now is putting crypto or pre-IPO SpaceX shares into your account. Every gain grows tax-free forever. Every sale inside the account is tax-free. By the time you're 59, you're either a multimillionaire or you lost it all. Number 3, hide your investments inside a life insurance policy. Private placement life insurance plus dynasty trusts. You give a chunk of your wealth, say $10 million, to a specialized insurance company. They put it inside of an insurance policy with your name on it. Inside that policy, the money gets invested into hedge funds, private equity deals, private credit funds, real estate. The investments grow tax-deferred year after year. When you need cash to live on, you don't withdraw the money. Instead, you take a loan from your own policy at, believe it or not, 1.5%. The IRS does not tax loans. When eventually you die, the policy pays out to your heirs completely tax-free, including all of the gains. Combine your PLI with a dynasty trust set up in South Dakota, Nevada, or Delaware. These specific states allow trusts to exist for hundreds of years. This is absolute generational wealth, where a dynasty fund set up correctly will compound wealth, act as a low-interest bank, and pay out to every generation. Number 2, the business expense ladder. How making more money lets you pay less tax. A teacher making $60,000 a year pays roughly 22% of their income in federal taxes. A billionaire making $600 million pays effectively as little as 8%. Because every wealth tier unlocks a new way to turn personal spending into business expenses. Individuals pay taxes on income first and then spend the rest. Businesses deduct expenses first and then pay taxes on what's left, if there's anything left. At $150,000 a year with a side business, your phone becomes a business expense. At $500,000 a year as a business owner, your car is a company vehicle. Your travel is research. Your meals with clients are deductible. At $2 million in net worth, you own things through LLCs. The LLCs hold the assets. The LLCs pay the bills. The LLCs take the deductions. At $10 million in net worth, you build a virtual family office, a part-time CFO, a tax strategist on retainer, and a state attorney year-round. But there's one move that exists at the very top, and that's number 1, the $10 million Rich Forever strategy, or the charitable remainder trust. Wealthy people use it when they're ready to liquidate a high-value asset. You own something worth $10 million, sell it the normal way, and hand $2.4 million to the IRS. The wealthy do not do that. They move the asset into a charitable remainder trust before the sale. The trust sells the asset. 0 capital gains tax. All $10 million stays inside and reinvested into index funds, earning 10% per year. The trust then pays you 5 to 8% of its value every year. That's $500 to $800,000 paid to you annually for the rest of your life. You never touch the principal because the money inside grows faster than what it pays you. But hey, Lux, what about the kids? You take a small portion of it and use it to buy a $10 million life insurance policy inside an irrevocable life insurance trust. When you die, the insurance policy pays out $10 million completely tax-free. The IRS got nothing. Now, save this video somewhere and come back to it when you're ready. You just realized how much more there is to the game of wealth and how little you actually know. So, Luxer, learn the rules of the game to optimize it. But remember, the goal at the end is to build a life you are happy with.